The gentleman from California, Mr. Royce, for 5 minutes.
Thank you very much, Chairman. You put together a very distinguished panel here of witnesses today. And I wanted to ask Mr. Tozer, given your past experience, and this is an issue that we've spoken about at LA at the Milken Institute out there, but given your expertise, again, if we wanted to explore what the risk transfer deals at Fannie and Freddie and NFIP have taught us thus far, if we look at risk transfer, we've had some deals through the bond and reinsurance market. My understanding is that they could be doing a lot more than they're doing already. Gwen Moore and I have legislation to encourage them to do that. In addition, I've recently been briefed that in light of the damage caused by the hurricanes, the contracts that the NFIP purchased will pay $1 billion of reinsurance, and that would return to the taxpayers 85 cents on the dollar as a consequence of those reinsurance contracts. So, given these and other examples, is there any reason why the federal government as an entity should not seek to maximize the transfer of credit risk and the transfer of insurance risk and other taxpayer exposures to the capital markets and reinsurance markets when practical?
I agree. I think you should excuse me, transfer as much of the expected credit loss as you can. I mean, the question you run into is diminishing returns. Like, for example, most analysis I've seen shows that really, if you, for example, transfer the 40% of the loan amount, like, for example, you have a $100,000 loan and you transfer $40,000 of risk to a third party, you're going to cover 99.9% of the chance of ever piercing that. So the question we run into is, when does the cost become prohibitive? It's like buying too much insurance.
Well, I understand the concept, but let me ask you, are we currently approaching, in your opinion, the point where...
Well, the thing I think when you realize is with the GSEs, and when they have a loan that has private mortgage insurance, they're insured down to 65% exposure right there. The borrower's paying to get them to 65%. So the big area that they're concerned about is the power loan puts down 20%. So I think the concern is making sure the loans that only have a 20% down payment are credit enhanced up to at least a 65 or 60% area. The loans that carry private mortgage insurance are probably pretty close to being what they need to be at because they're at 65%. But I think you need to look at this whole concept, what's the tipping point of the cost versus the benefit to the taxpayer, and then also to the question also, Fannie and Freddie's capital should be also, or if you have an issuer in the future, that should also be there to protect against the government. So the question becomes between all those layers, I think the question is the government should make sure that all the losses are absorbed by the private sector.
Right. And in your testimony, you state that many have cited deficiencies and weaknesses in PLS contracts, governance, structures, and collateral as a leading cause of many billions of dollars of misallocated losses. These misallocated losses spurred a crisis of confidence and the resultant trust gap on the part of the institutional investors who bore them. So we heard similar concerns at our hearings last week, right?
Right.
My question is a straightforward one here to you. What reforms could we make to help repair the trust gap and reignite the PLS market here?
Well, the key, I think, is we have to have an active master servicer. Because what's happened is, for example, in the Ginnie Mae world, if an issuer hires a servicer, they're on the hook for the losses. So they're going to keep them to make sure there's no misallocation. If a servicer messes up, they pay the losses. The same thing, Fannie and Freddie are acting as a master servicer to make sure the servicers, you know, if they mess up, they lose. In the private global securities, it was kind of like trust me. The servicers got it to kind of control the henhouse. So the key thing is having a layer of someone there to do the oversight over the servicers to make sure that if they make a mistake that causes losses, that those losses are absorbed by the servicer and not passed on to institutional investors by making stronger contracts, but also having a organization that actually has the teeth to enforce those contracts versus letting the servicers kind of police themselves.
Anything else that could reignite the PLS market?
Well, the PLS market in general, I think, is going to be, it's always going to be relatively small because, not so much because of the credit side. I think there is tremendous appetite for credit investors. The problem is interest rate investors want the homogeneity of being able to have a government-backed security that they can trade large amounts in the TBA market. So I think the concept is, I think the PLS market, as far as the credit side, through the CRTs, I think it's critical to develop because as we can move to the point where more and more credit transfer is occurring, especially if we get to the point where we have more and more issuers, like we talked about in the milk proposal, we need to have a good working private sector credit transfer process. And I think that's what we need to make sure we have in place.
The gentleman's time has expired. The chair now recognizes the gentleman from Texas, Mr.